Welcome in, everybody. Ready to dive into a world that most people only kind of get, but which impacts us all in a pretty major way.
You're talking private equity, right?
Yeah, private equity, we hear it all the time these days. Trillions of dollars, big deals. But like, what is it, really?
And does it even matter to, the average person?
Exactly. So that's our mission today, demystifying private equity, figuring out how it works, who the players are, and yeah, whether we should care.
Because it's not just for Wall Street anymore, right? We're seeing this trend of private equity reaching into more and more corners of the economy, even into things like, well, I don't want to spoil it yet.
Right. Keep us in suspense. But yeah, let's back up for a sec. For anyone who's totally new to this, what's the elevator pitch definition of private equity?
Okay, so imagine companies, businesses, but they're not on the stock market. You
Hmm.
can't just buy their shares like you would with Apple or Google. They're privately held,
So more exclusive then.
much more, and that's where private equity comes in. These firms, they pool money from, well, wealthy individuals, institutions, and increasingly regular folks, and they use that money to buy, improve, and hopefully sell those private companies.
Ah, so they're like the middlemen, connecting
Yeah.
investors to these kind of hidden businesses.
And they're not just passive investors, they're very active. They have these general partners, the GPs. They're the brains of the operation, making the investment decisions.
So GPs are like I don't know, the coaches in the team calling the plays.
And their players are the companies they invest in their portfolio. But to get these companies, they often need a lot of cash, and that's where leverage comes in.
Leverage, that sounds a little risky.
It can be. It's basically using borrowed money, debt, to make the purchase. Often they use the company's own assets as collateral, kind of like a mortgage on a house.
But on a much bigger scale, I'm guessing.
Yeah, we're talking hundreds of millions, even billions of dollars sometimes. And this is how they do those massive leveraged buyouts, LBOs you hear about.
LBOs, sounds intense.
They can be, think of it like this. A PE firm wants to buy a company worth $100 million, but they only put up $20 million of their own money. The rest is borrowed.
So they control a much bigger company than their initial investment would allow.
Right. And if they can improve the company, sell it for, say, $150 million, they make a huge return on that initial $20 million. But of course,
If it goes the other way?
oh yeah, the losses can be amplified too. That's the risk with leverage, high reward, high risk.
So we've got the players, the GPs, the LPs, we've got the strategy, LBOs. But what about I don't know, the ethics of all this? Is private equity a force for good, or is it all about squeezing profits no matter what?
That's the million or trillion dollar question, and there's no easy answer. There are definitely cases where private equity has helped turn around struggling businesses, save jobs, even create a whole new industry.
But then there's the flip side, right? We hear about companies being loaded up with debt, jobs being lost, assets being stripped, all in the name of profit.
Yeah, and that's where things get controversial, because critics argue that private equity's focus on short-term gains can sometimes be at odds with the long-term health of the companies and the people who work for them.
So it's not as simple as good guys versus bad guys.
Not at all. It's a very nuanced situation, and it depends on a lot of factors: the specific firm, the industry, the overall economic climate. It's complicated.
Well, that's what we're here to unravel, the good, the bad, and the complicated. So listeners, stick with us as we go deeper into the world of private equity.
So how do these private equity firms actually make money? I mean, they're not doing all this just for the thrill of it.
Yeah, good point. So we got to talk about the money, the fees, the structure, the whole financial engine of private equity.
And this is where it gets interesting, because there's this kind of infamous fee structure in the industry. It's called 2 and 20. You might have heard of it.
2 and 20.
Yeah.
Yeah, it does sound kind of shady, like some secret society or something.
Yeah.
What's the deal with those numbers?
Well, they represent the two main ways that PE firms get paid. The 2 refers to an annual management fee. It's typically 2% of the total assets that they're managing.
Okay, so 2% of it, like all the money they're investing.
Exactly. It's like a subscription fee that investors pay just to be in the fund, and this covers the PE firm's operating costs, salaries, rent, research, you name it.
So even if they don't make any successful investments, they still get that 2%.
Yep, and that's one of the points of contention. Critics say that it creates a potential conflict of interest because the PE firm is making money, regardless of whether the companies in their portfolio actually perform well.
So there's not as much incentive for them to, really focus on the long-term growth of those companies.
That's the argument, but then there's the other part of the equation, the 20, that's the carried interest, and this is where the big money comes in for PE firms.
Carried interest. So they carry a portion of the profits if things go well.
Well, they typically get 20% of any profits that the fund generates above a certain hurdle rate, so this is their incentive to actually make those companies profitable.
Okay, so that makes sense. But how does this 2 and 20 structure play out in the real world? Like, are there any examples of where it maybe went wrong?
Oh, yeah. There are definitely cases where this fee structure has been criticized for leading to short-term thinking and decisions that prioritize profits over long-term sustainability. One example that comes to mind is the case of Toys R Us.
Toys R Us, that was a big one. Everyone remembers that. What happened there?
Well, Toys R Us was acquired by a group of private equity firms back in 2005. And while there are other factors at play, some critics argue that the PE firms involved loaded the company up with debt and then focused on extracting fees and dividends rather than investing in the company's long-term future.
So they were basically milking the company for all it was worth instead of trying to make it thrive.
That's the accusation. And ultimately, Toys R Us ended up filing for bankruptcy in 2017. It was a pretty dramatic downfall for a company that was once a beloved icon of childhood.
Yeah, it's a sad story, and it makes you wonder if things might have turned out differently if the focus had been on long-term sustainability rather than short-term profits.
That's a question that's often debated in the context of private equity. Another controversial tactic that sometimes comes up is something called a dividend recapitalization.
Dividend recapitalization, that sounds complicated.
It can be, but essentially it involves a PE firm having the company they've acquired take on more debt and then using that debt to pay themselves a big dividend.
So they're basically using the company's future earnings to enrich themselves today.
Yeah, it's a way for them to get a quick return on their investment, but it leaves the company saddled with a heavier debt burden, which can make it harder to invest in growth or weather any future economic storms.
This is a risky move for the company and potentially for the employees and the communities that depend on it.
Right, and it highlights one of the key criticisms of private equity, that sometimes the pursuit of quick profits can come at the expense of long-term sustainability.
And potentially at the expense of people's livelihoods, too. I mean, if a company goes under because it's been loaded up with debt, that's a lot of jobs lost.
Absolutely, and it can have ripple effects throughout the entire economy. One of our sources, Private Equity's Pillage, How Firms Exploit America, goes into detail about some of the negative consequences of these practices.
They argue that it's not just about financial engineering. It's about people and communities.
Exactly. They highlight cases where PE firms have acquired companies, cut costs, laid off workers, and ultimately left those communities worse off than they were before.
So it's not just about abstract numbers on a balance sheet. It's about real people's lives.
That's an important point to remember, and it's something that we need to keep in mind as we evaluate the role of private equity in our economy.
Because as we discussed earlier, private equity isn't just a small niche industry anymore.
And
It's become this massive force with trillions of dollars under management.
And that raises a whole other set of questions like what happens if this bubble bursts? I mean, we've seen bubbles before in the tech sector, in the housing market, and the consequences can be devastating.
That's a scary thought, especially if private equity has become so deeply embedded in so many different industries.
It's definitely something to consider, and there's a lot of debate about whether the industry is overvalued and vulnerable to a correction. Some experts argue that private equity has weathered previous downturns relatively well.
But others are sounding the alarm bells, right?
Yeah, there are definitely concerns that the high levels of debt used in many PE deals could make companies particularly vulnerable if interest rates rise or if we hit a recession.
So it's a complex situation with a lot of moving parts and a lot of potential risks. And that's why it's so important to understand how private equity works and what the potential consequences could be.
Because whether you're an investor, an employee, or just a concerned citizen, this is an issue that could have a significant impact on your life. It's important to remember, too, that private equity isn't a monolith, right? There are different types of strategies, different approaches within the industry.
Yeah, we've mostly been talking about those big leveraged buyouts, the LBOs. But there's more to it than just that, right?
Right. Like one area that's been growing is growth equity. That's kind of what it sounds like, investing in companies that are already doing well, but they need capital to like expand, develop new products, that kind of thing.
So it's not about taking over a struggling company. It's more about partnering with a successful one to help it reach its full potential.
Exactly. And then you've got venture capital. That's a whole other world. They focus on startups, early stage companies that are developing brand new technologies, the ones that could become the next Google or Amazon.
Ah, so they're the ones taking the really big bets on those unproven but potentially game-changing ideas.
Yep. And venture capital has been a huge driver of innovation, but it's also super high risk. Most startups fail, so they're really looking for those few that can hit it big.
Makes sense. So when we talk about private equity, it's really an umbrella term for a whole range of investment strategies, each with its own risks and rewards.
Right, and I think that's something investors need to be aware of. You can't just lump all PE firms together. You got to look at their specific strategy, their track record, their fees, all that good stuff.
So it's about being an informed investor, doing your homework, not just jumping in because you hear private equity is the hot new thing.
Exactly. And one thing that I think is really important to consider is the alignment of incentives. Like, are the PE firm's goals the same as yours as an investor, or are they potentially working against you?
That's a good point. And one of our sources, I think it was private equity, in essence, Plunder, they were pretty critical of how that 2 and 20 fee structure can create these perverse incentives where PE firms can profit even if the companies they invest in don't do so well.
Yeah, that's definitely a valid concern, and it highlights the need for transparency and accountability in the industry. Investors need to know what they're getting into and what the potential conflicts of interest might be.
And I think that's true not just for investors, but for anyone who's impacted by private equity. Whether you're an employee of a company that's been acquired by a PE firm, or you live in a community where a PE-owned company is a major employer, these decisions have real-world consequences.
Absolutely, and that's why I think it's so important to have these conversations to shine a light on how this industry works, the good, the bad, and the complicated. Because it's not just about money, it's about people's lives, it's about
Yeah.
the future of our economy.
Well said, and I think that's a good note to wrap up on. So for everyone listening, we hope this deep dive has given you a better understanding of the world of private equity, its power, its potential, and its pitfalls.
And remember, this is a constantly evolving industry, so stay informed, stay engaged, and don't be afraid to ask tough questions.
Exactly, because knowledge is power, and in the complex world of finance, that power is more important than ever.
As always, be sure to check out the show notes for links to all the sources we mentioned, including that video from Sven Carlin about the potential PE bubble. And remember, all this has been for informational purposes only, not investment advice.
So do your own research, think for yourself, and until next time, happy investing, everyone.